Welcome, welcome, everybody. I will get started here. Today, we're talking, as I just said, about RMDs. And for those of you who, most of you know me, but if you're not familiar, my name's Anthony Gerbi. I've been with Stein Financial Group here for now over 10 years. And I can walk you through A through Z on our RMDs. And we are going to hit most of the top level items that relate to RMDs this year, what they are, how they work, things to think about, some advanced strategies for those of you who have questions. Of course, I may not be able to cover absolutely everything that you had a question about, so please, there's a Q&A feature at the in Zoom, and if you're on your phone, it's potentially in the menu somewhere. If you're on your computer like I am, it's down towards the bottom for me. But there's a Q&A feature you can type in there. You can send it just to me, and so I can answer it, anonymously. So it doesn't, or you can send it to the general chat and then everybody can see it. And at the end, we'll even have time where you can hit the raise your hand button and I can unmute you and you can even ask a question. So please fire away with questions. I'll pay attention. And if I'm in the middle of explaining something, Aaron, who's also on here and helping today, we'll be paying attention. So we'll get to the questions. We'll go through everything, and let's go ahead and get started here. And let me move myself and adjust that just a little bit. Perfect. Okay. I will stop here for just a second. This says definitions. We're going to go over a lot of this stuff, but it's just the fine print that we need to make sure is included in here. So I'll try to get out of the way a little bit there so the whole thing can read. And by the way, this is being recorded, this presentation, so it's going to go up on our YouTube channel for you to reference back later, or if you have somebody else in your life that you really think needs to know this, they can go reference our YouTube channel, and that is if you just type in Stein Financial Group YouTube to Google, um, it will show us. We will come up. So thank you, everybody, and let's get started. So questions about RMDs here. This slide, I think, is the scary version of this conversation, right? Which is this is what I think people worry about. What are the rules, Anthony? And it's been made more confusing by the fact that they've changed over the past couple of years. I've heard there are penalties. Yes, there are. That's why we have to get this right. When should I take my RMD, and what are my obligations in terms of how do I make all this work? But let me go way back for a second. Okay, let me go way back to the beginning. I've said RMD a bunch now. Now I'm assuming you probably have an idea of what RMD is because you're on this meeting. But let me go to the absolute basics. RMD stands for Required Minimum Distribution. Required minimum distributions are amounts of money that have to come out of pre-tax retirement accounts. That's 401ks, 403bs, IRAs, 457 accounts. So, oh, and thank you, Aaron. I was just looking down and I saw the note. Aaron linked our YouTube channel in the chat. So, if you want a direct link, it's right there. So this slide does a good job of giving you the definition, right? Why does the money have to come out? A lot of people ask me that. It's for the obvious reason. It's because the IRS is forcing you to take money out in order so that you have to start paying taxes on this pre-tax money you've saved, right? So a lot of people on this call, if you don't still have one, you did in the past, have a 457 retirement account. If you worked for Hennepin County, for example, and all the years that you were saving into that account, it was going right out of your paycheck into that account without being taxed. So we call that money sitting there pre-tax. And that is a good thing because it allows that money to grow, to compound on a pre-tax larger number. I mean, you don't have to deduct the 20% or whatever your tax rate would be before it goes in. You get to keep that whole chunk in there so then it can compound on a bigger number. That's great. The trade-off for that is the IRS says, okay, at some point, we're going to start making you take the money out because we want our tax revenue. That's essentially the reason why RMDs exist. That's why they're going to continue to exist. And that's why there are penalties for getting them wrong, because it's all about tax revenue. So that's the reason behind it. What does it mean for you? And if you see at the bottom there, the last bullet point, this is the big thing for everybody to know, I guess, is age 73 is the time when you have to take this. It used to be 70 and a half. Just a few years ago, pre-2020, it was age 70 and a half, which is weird because a half year is always confusing. That always confused people. I don't really know why they did it that way. In 2020, they raised it to 72. And then in 2022, they raised it to 73. And actually, I'll explain later, for those who it might be way out in the future for, it's going to get raised again in 2033. But basically, all you care about for the near future is what's the year that I'm turning 73? Okay. And it's not the day you turn 73 that matters. It's the year you turn 73. So even if your birthday is December 31st of 2025, let's say, 2025 is then the first year you have to take RMDs, and you don't have to wait until your birthday. That's one of the common misconceptions. I hear people say, well, my birthday is not till September. So if I take money out right now, it's not going to count towards that. No, as long as it's the right calendar year, it does count. So that makes it a little bit easier. The other thing, and this is worth knowing, but I don't actually encourage people do this for the most part. There are some circumstances where it would make sense. But again, that very bottom bullet point there. In your very first year of taking RMD, so the year you turn 73, they give you a grace period. They say, actually, you can wait until April 1st of the year following the year you turn 73. So again, let's make this concrete. In 2025, let's say I'm turning 73. I could wait until April 1st, 2026 to take my 2025 required minimum distribution out. I get a 4-month, 3-month, I guess, January through March grace period. That is a one-time deal. Every year beyond that, it's got to be out by December 31st. And I encourage everybody, even in their first year, to still take their RMD in the calendar year they turn 73, because you still have to take another one your second year. So if you wait until March 31st, for example, then you have to take 2 RMDs in the same calendar year, which matters for taxes. Now you're doubling the amount of income that you've had to take. So that's why it's generally not advantageous to do it that way. There are some circumstances, and that would be something we'd talk about one-on-one. But in general, you want to take it the year you turn 73. And then that begs the question, and this is one of the most popular kind of strategizing pieces we do. When should you take your RMD? Okay. So that first bullet point to this shoulder, it's my right shoulder in real life, explains that in 2033, the age is going to go up again. But we're 8 years away from that. I'm not going to worry about that for right now. 73 is the magic number. So when you should take your RMD, by the way, Roth accounts, so Roth IRAs, Roth 401ks, Roth 457s, anything that's got money post-tax, and that's what a Roth is, by the way, just to go back a second. Regular retirement accounts, money goes in pre-tax, comes out, it's taxable. Roth is the opposite. Money that goes in has already been taxed, and all the dollars that come out are tax-free. So with that in mind, you can kind of see why it doesn't make sense that RMDs would be required of Roth accounts, right? You don't pay any taxes anyway, so why would they force you to take the money out? And that has now been corrected. A few years ago, you actually did have to take RMDs out of Roth 401ks, 457s. But now they've fixed that weird loophole. It was always a little bit of an oversight. So if you have a Roth account, don't worry about this. Doesn't apply to that account. But when you should take your RMD is an important question. And first off, I always kind of triage it in this way. Okay, and I'll break it down. First off, your RMD is calculated. I think the next slide may even have this. Yes. Your RMD is calculated based off of the December 31st balance of the year prior. Okay. So let me use 2025 as an example again. If I'm turning 73 in 2025, that means my December 31st, 2024 balance is what is used to calculate my RMD. Okay. That's the number that gets locked in. So I could take out my entire RMD on January 2nd, the first day the markets are open after the new year. Okay. I could do the whole thing and just get it done with. And we do have some people who like to do that. They like to just say, yep, I'll just take it then. It'll be done for the year. I don't have to think about it. Good. I would say that's not the most common way to do it, but there's absolutely nothing wrong with that because the first thing you should think about when it comes to your RMD is, do I need this money or do I want this money? Right? Do you have a trip coming up that you were like, well, I'm gonna take out some money anyway, so let's kill two birds with one stone. I have to take out this amount. I need it right now. Let's just do it. Do you have other expenses, right? Like it doesn't have to be a trip. It could be I've had some repair bills come due. I'm getting a new car. I'm whatever. If the money is useful to you in your pocket, let's just take it out. And then it will count towards your RMD, even if you haven't had your birthday yet, right? It only matters if it's the calendar year. So that's option number one. Option number two is I don't really need this money, Anthony, right? Like if it was up to me, I wouldn't take it out in the first place. What do I do with it? That's where it gets interesting. That's where you have multiple options. So first off, money still has to come out. There's no way around that. So you could say, well, I don't need the money. Let's just take it in 12 equal chunks throughout the year. Let's just make it simple. So I'm going to take 1/12 of the amount every month. Let's say first of the month, I'm just going to get a check for whatever the amount is. And by the end of the year, I'm done. Okay. And that's what a lot of people end up doing because it's just, yeah, it's money there. I will figure out what I'm going to do with it. I would say the second most popular, maybe tied for the second most popular way of doing it, is waiting until the end of the year. And here's the thinking behind that, because I have a lot of people who ask me, when is the best time of year to take out the right amount, right? And you can't know in advance is the problem. If I had a crystal ball, I could tell you the day you should take the money out because the idea would be I would rather take the money out when my account was at its absolute highest, right? When it's grown so that the money can stay in while it's growing and then take it out right before it stops growing, right? At least for that small period of time. Well, if you look at the statistics, 7 out of every 10 market years is positive, right? So 7 out of every 10 years, historically speaking, and again, that's just history, which doesn't necessarily mean that it's going to happen that way in the future, but it does give us something to go on. Historically, if 7 out of every 10 years are up, then 7 out of every 10 years, you're better off having waited until the end of the year to take your RMD. And for the simple reason of that money then got to stay in that account to grow all throughout the year, and then you take it out in November, December. So I would say the two most popular options that we run into are equal monthly chunks throughout the year or waiting all the way until the end of the year to do it. But again, there's no reason you have to do that. And if you have an expense coming up, many of you who are already taking RMDs have experienced this. You'll call me up and say, hey, I've got this thing. I need to take some money out. And I'll look at it and say, well, you have an RMD this year anyway. Let's just take it from your pre-tax account. So we kill two birds with one stone. And that's just fine. If you need the money, that's what it's there for. Okay. So as far as timing, those are the things to consider. When do you need it? And if you don't need it, maybe you can consider waiting until the end of the year because otherwise something else might pop up throughout the year where you need it too. And then not that this would be bad, but one of the things where we'd look back and say, ooh, I guess I didn't do that perfectly is let's say you're one of those people that says, I don't need my RMD this year. I don't need to take any money out. I'm doing just fine cash wise, which is great. That's the ideal, right? But you do it anyway. You say, well, I'd just rather get it done with. I want to, get it over with and I'll do it in January. And then all of a sudden in November, an expense pops up where you're like, I got to take more money out. Well, if you didn't need it in January, we could have waited until November and just taken out the right amount then, and then you wouldn't have had to take out more and then pay more taxes. So again, we can't know this in advance, so I don't want you to beat yourself up about it. You can't know whether the account's going to go up for the year, whether you're going to need the money later. All those things are in flux, so we just do the best we can. But those are the things we think about. And by the way, I help you think about them, right? I'm going through a lot of different if-thens, and the real answer is let's just talk about it, you and I can help kind of guide you. Ooh, okay, it sounds like you're a good candidate for this. That one doesn't sound like as smart of an idea. And because again, we do this in Stein Financial Group. We do this literally hundreds of times a year, deal with RMDs. So we have great practice in doing it. This is a table. Don't feel like you need to write these numbers down. and calculate it yourself right here. We do that for you. And but this is actually how the RMD is calculated. So for whatever age you are that this year, 2025, you divide the balance of your pre-tax account by this factor. And you can see the factor goes all the way through, age 103 here. A quick question. If you don't need the money, can't you just move it to another retirement account that is taxed going in? Um, yes, except it can't be another retirement account. So I'm going to get to that in a second, but let me briefly answer that question right now. So the question is, if you don't need the money, can you just reinvest it? And the answer to that is yes, you can. And that's one of the most popular things we do. We can set up a non-retirement account for the money to go into. You still pay the taxes. We help you withhold for that. So you don't have to cut a check to the IRS. We'll withhold the taxes for you. But then it immediately gets reinvested and you keep it growing. What you can't do is put it into like a Roth IRA, another retirement account. I wish you could. In theory, you'd think, why can't I? That seems like yeah, it's a post-tax account. So if I pay the taxes, why can't I put it in? That's just the way the rules are. You cannot take an RMD and put it into a Roth IRA unless you contribute to the Roth IRA because you have work income. So like if you're still working, then potentially you can, but you can't just do from one to the other, especially if you're retired. So that's a very common question, but you can do to a non-retirement account, meaning just a regular old investment account. You pay taxes on the gains in those accounts, but yes, you can reinvest it. Very common strategy. We do a lot of that. So basically, how that works is we set up another investment account for you. It can be invested even the same way that your retirement account is with the same investments. And then we can just literally wire it from one to the other. And we'll withhold the taxes. You'll get a statement. I'll explain all how that works in just a minute. But it's very quick and easy. So that's another common way to go. That's a very good question. Again, please don't feel like you have to do the math here. We do that for you. And everybody, even those of you who are in deferred comp still and still have Voya as the company you work with, you will get a letter from them at some point, probably in January here. If you haven't gotten it, it's probably coming out soon. And we also send them out for everybody who works directly with us that will tell you the amount to the penny that you have to take out for your RMD. So don't worry about calculating it yourself. Obviously, you can if you like to, and there are some great calculators out there. But we will send you a letter that's got the right amount. We've got it in our database, and we will make sure that the right amount comes out by the end of the year. That's another nice thing that Voya does. If you happen to be with them right now, they will, I believe they still do this. I don't speak for Voya, but I believe this is still how it works. If you have any remainder that has to come out by December 31st, they'll just send you a check for it. That's what they've done in the past. So that really gives you some peace of mind that, hey, even if I'm trying to figure this out and I screw it up by chance, there's still a backstop there where Voya will make sure that you're following these rules. Because, and this is the only time I'm going to mention this, it's on a couple of the slides, but nobody should ever have to deal with this. There is a penalty for not taking out the right amount of an RMD, okay? And that is 25% on the undistributed portion. So not only do you still have to take it out and pay the normal taxes on it, you get hit with another 25% penalty tax on top of it. So not a mistake we want to make. We will make sure that you do not fall into that if you work with us. And if you're still in deferred comp and you work with Voya, again, they're watching it, but please feel free to consult with us and we will help you figure that out. That's exactly what we're here for. Another question. What if I have more than one retirement account? What if I have deferred comp and a retirement account? I think we have a slide that might deal with that, but I'll just answer that right now as I move to the next one. So, question is, if I have, let's say I started an IRA when I was 25 and just starting out at work, and then I got my job at the county, let's say, and I have a 457 there, and they're both pre-tax accounts. How does that work from an RMD perspective? First off, do I have to take from both of them? The answer is yes, you do. If you have an IRA here and a work retirement account, 401k, 403b, 457, you have to take the right amount from each account separately. Okay? So let me say that again. You take each one separately, run the formula, and say, I have to take this much from the IRA and this much from the 457, and I do that correctly for each account individually. That's very important. If you have multiple IRAs, I have an IRA over here and I have one over there, and I had a work account, but I rolled it into an IRA over there. If that's the case, you can pool the amount. So you could take the amount for three IRAs all from one if you want. And there's no advantage or disadvantage tax wise to doing it that way. You're going to pay the same taxes either way. And that gives you a lot of flexibility to say, well, if one of my accounts is super aggressive and the other one is really conservative, well, in a really good year, I'll take from the one that's aggressive, that's growing a lot. And in a bad year, I'll take from the one that's really conservative for, both of them. I'll pool them. But again, remember, that's only for multiple IRAs. If you have a 457, regardless if you have other IRAs, you got to take the right amount out from the 457 individually. IRAs can be pooled, 457s cannot be pooled. So very important that you understand that because again, this is one of those little minutia things that can get a little tricky here. So how will your RMDs affect your tax situation? Again, this is the whole purpose of RMDs in the first place, right? RMDs are treated as income. It's just like you're getting a paycheck from work. Okay. It's income tax. So you don't have to worry about the gain on it like you do with other types of accounts. You don't have to worry about dividends or interest or anything like that. Just whatever dollar amount comes out, that's now income as far as your taxes are concerned. There is one exception. So one of the most common questions I get about RMDs is, Anthony, I don't need this money. I'd rather not take it out. I consider reinvesting it, but I understand I'd still have to pay the taxes to do that. Is there any way to satisfy my required minimum distribution without paying taxes? And the answer is yes. There is one way to do that. The one way to do that is any dollars you would like to donate to charity, you can donate. You won't pay taxes on, they won't pay taxes on either, the charity, and it counts toward your required minimum distribution for the year. So let me make that clear. Let's say my required minimum distribution for this year is $1,000, and I would like to donate. I normally donate maybe $100 to the Red Cross. It can be a local charity, it can be an international charity, anything that's got a 501c3 is registered as a nonprofit counts toward this. So I normally send them $100 every year, let's say. Well, let me do it this year out of my IRA. And this rule only applies to IRAs. So those of you who have 457s, you can't do it out of a 457. It can only happen out of an IRA, which is the individual retirement account. That's what IRA stands for. I think I've said that a bunch, the acronym without explaining what that means. That's just the private version of your workplace plan that you can move a 457 into an IRA. And in fact, we have a lot of people who do move 457s into IRAs. Partially, one of the reasons is to take advantage of this. If you give to charity already, you can do your charitable giving out of your IRA, and it's going to be more advantageous for you tax-wise, most likely, and it's going to count towards your RMD without having you have to pay tax. So I'm going to go into that a little bit deeper on a slide just in a few minutes, but just know that is the answer to the question. Is there any way I can do this without getting a tax bill? Yes. You have to give the money away, so it's not like you can keep the money, but there is one way you can do it that way. We should talk about what the most efficient strategy is. This is a good time for me to just mention how the tax situation works. When you call us up and say, hey, I'm RMD age, or realistically, when we call you and say, hey, you're RMD age, let's talk about what the best way to go about this is. Whenever you take the money out, assuming you take some of it to you or you reinvest it where taxes are due, we withhold the taxes for you. We can withhold at whatever percentage you would like. Some people withhold a lot. Some people withhold very little. It all depends on your personal tax situation. We can help you kind of navigate that. Though I'm not an accountant, but I can help you kind of figure that out, what the best withholding would be. And then what happens is a year after, so in February of 2026, you will get a tax statement from us that says, hey, you took out $1,000 from your IRA last year, and here's how much we withheld for you. And it'll be based off what we had already agreed upon earlier, but it'll give you the dollar amount. When you do your taxes, you plug that right in. You say, I took out 1,000, so that added onto my income, and I withheld this much. And it'll go right into your taxes. If you do your taxes yourself, it's pretty self-explanatory. And it's certainly if you work with a professional, they know exactly what it is. They see it all the time. So very quick and easy to deal with. The amount that comes out in total is also reported automatically to the IRS. So they're going to know that you took out the right amount. You don't have to go put that in separately or file that in a separate way or anything like that. It's all automatically done. So you're not going to get a question with it. There are a couple nuances if you do the charitable giving tax wise, and I'll explain that in just a few minutes here. So we touched on this because some of the questions got there, but after you've paid the taxes, you can do whatever you want with the money, right? So the first thing you should do is consider whether you need or want the money to spend, right? I'm not saying just spend it just to spend it, but if there's something going on where you're like, I could actually use this money, that's always option number one. Again, the number one thing, I've said this many times before, but I'll say it again. I'm a financial advisor who's going to encourage you to use and spend your money. Not in a wasteful way, of course. That's where I come in to help with that. But genuinely, I want to see you spend the money on things that are meaningful to you. So that's always option number one. But let's say again, and this goes back to the question that was asked earlier. Okay, I really don't need this money. What else can I do with it? You can reinvest it into a taxable account. So absolutely, you can do that. You still have to pay the taxes, but you can absolutely reinvest it. Lots of people do that. You could contribute it to a loved one's college savings account, grandchild, child, friend. If they have one already, you can just put the money in there. Again, that falls into the category. You can kind of do what you want with it. You could gift it to someone. None of those things avoid the taxes on it. Again, there's only one way to avoid the taxes, but just open your ideas, open your mind to the possibilities of what you can do with it. Again, you don't have to spend it. You can save it. You can put it in your savings account. You can reinvest it in an investment account, but you can also do lots of other things. And we can talk about that. And I can not tell you what to do with it, but I can give you some ideas of what other people have done with it. So that's absolutely what you can't do. And I touched on this earlier as well. You can't put it directly into a Roth IRA. Okay. For what I wish they would change that rule. I personally think it would be a benefit to everyone to do that, but rules are rules. That's just what the IRS rules are. You can't not take it without a penalty. Of course, you cannot take your RMD, but it's going to catch up with you eventually. You do not want to go down that road. Everybody on this call, because you're on this call, A, you're proactive about this, which is fantastic. But B, if you're working with somebody like us, we're going to make sure you're following the rules there. And if you're with Voya or you still have your deferred comp that we're not directly overseeing, just talk to us and we can help you make sure that you're following those rules. And I have not mentioned this yet, and this is another of the most common misconceptions I see. So if you're taking notes, this is a good one to remember because this, I can't tell you how many times I've been in a meeting and I'll hear, somebody at my coffee group mentioned this. And it seems it's like a virus. It seems to pass from one coffee group to another coffee group. And what they tell me is I heard that because of these RMDs, I'm going to eventually drain my account to nothing. They're going to make me take out my whole account. And that is not true. Okay. And here's why. You are going to have to take an amount out of your account every year for the rest of your life once you turn 73. That is true. The amount you have to take out is going to escalate in percentage every year. Okay. So the first year you take money out, it's a little less than $4,000 for every 100,000 you have invested. Okay. So if I have a $100,000 account, I'm taking out about 3,800, I think it is right now. Maybe it's 3,900 right now, a little less than 4,000. If I have $200,000 in a pre-tax account, double that. So now I'm just a little under 8,000, okay? And that percentage is going to increase as I get older to the point where when you're in your 90s, you're going to be taking out 10% or more of your account every year, which is a lot, no doubt about it. But it always resets based on the previous year's balance on December 31st. So let me explain that. Let's say I have $100,000 and this year, and that's what I had on December 31st of last year. So that's my number for this year. And I have to take out my 3,900 bucks, just a little less than 4,000. Well, next year, let's say I have $90,000. It went down even beyond what I took out, right? Hopefully that doesn't happen, but just to illustrate the point. Then 90,000 is my new formula number. It's not going back to the original balance when I started RMDs. It's always recalculating every year based off your new year-end balance. What does that mean? As the years go on, even if your account goes down, which a lot of people take RMDs and their account still goes up, which is the goal, I would say. But even if the account goes down and the percentage you have to take of that account goes up, the chunks will get smaller and smaller. The actual dollar value will get smaller to the point where you will never empty your account from taking RMDs alone. It's impossible. And the reason it's impossible is because it's only ever a percentage of what you have left in the account. So even if your account dwindles and it goes from 100,000 down to 10,000, again, that's a pretty extreme example. I don't think that's really going to happen for anybody. But if it did, then your balance would be 10,000 that would be running the formula off, and you'd have to take out much less than you did your first year. So know that it's always a percentage of what you have left. So it's never going to be the entire amount. Okay. And that's one of the most common misconceptions. And I have people all the time who come up to me and say, well, shouldn't I just spend it now before the government makes me take it out and spend it? And I'm like, well, no. No, you should spend it when you want to spend it, don't get me wrong. But the government doesn't force you to take the whole amount out. That's again, that's a an idea out there that's misplaced. Um, when do you need to receive your RMD by? I touched on this a little bit earlier. December 31st is really the best time before then, excuse me, not that day. Please don't wait till December 31st to do it. We're going to be more proactive than that, but if you have other accounts, let's say, with either other groups or a work account, please don't wait till December 31st to call them and say, "Ooh, I need my money." One, things always slow down around the holidays every year. Two, there's about 1,000 other people who do think that's a good idea, and you're going to be lucky to get your money out if you call that same day. So please be proactive. December is fine. December 1st is fine. December 15th is usually fine. Don't wait till December 31st because that is the deadline. Again, unless it's that first year, and I still don't encourage people to take advantage of that grace period the first year because then you just double up the second year. Um, and again, you do not have to wait until your birthday. So if your birthday is in September, you can take it in January because again, it's always calculated on the last day of the year prior. So everybody on this call who has an RMD this year, we can look up what your RMD is right now, regardless of when your birthday is, because we know what the December 31st balance was. Um, what if you don't take your RMDs? I'm not going to spend much time on this. There are penalties. You do not want the penalties. That's why we're going to be proactive. So please don't. You're on this webinar because you are taking it seriously. I guess what I'll use this for, my little soapbox, is if you know somebody who's turning 73 and maybe you know that they're not usually on top of this stuff in the way that maybe you are or that you feel they should be. Um, Check in with them. You don't have to do it for them. Their account's going to be somewhere they can talk to them. But just say, "Hey, do you know what an RMD is? Or do are you aware of this?" And if they're a little confused, first off, you can absolutely send them our way. But secondly, just remind them that, hey, there's some penalties here we need to be on top of. I think we should get on top of this. And that doesn't happen a lot, but it can be a really expensive thing if it does happen. Okay, so now I want to talk a little bit more about the charitable donations. So, the way this works again, I laid it out a little bit before, but let me do it again real quickly here. It's the only way to take your RMD without paying taxes. And the only accounts that are eligible to do this are traditional IRAs. Okay? Not 457s, not 403Bs, not 401ks, not inherited IRAs. And I haven't mentioned inherited IRAs and IRAs that you literally inherit from someone who has passed away. I'll touch on that briefly before the end here because those also have RMDs, but they're a little bit different. Um, but only traditional IRAs can do this. And how it works is like if your account's with us, I'll explain it. You send us a list of the charities and amounts that you would like to donate to those charities. And again, it can be local organizations, it can be national organizations. As long as they're a registered nonprofit, good to go. We need their nonprofit number or their 501(c)(3) number. We need the address the check is going to, and then we need the amount, basically. And that's all we need. We can send you the check, and then you can send it off. But the one thing we can't do is make the check out to you, you deposit it in the bank, and then write a new check. No, the check is going to be made out to the place from the get-go. That's why you don't have to pay the taxes on it, because then the IRS knows it's not going to your pocket. There's no way to get around that, right? So it's just making sure. But again, if you know that you already are donating it every year, let me explain why this is even more tax advantageous than just cutting a check to a charity. So, because of the tax laws that changed in 2017, these were the tax cuts, the standard deduction on everybody's taxes, yours, mine, everybody's, doubled. So now it's like, I think it's like $13,000 per person. Okay. And actually, I think it's even more than that this year. But what that means is you either itemize or you take the standard deduction, whichever one is better for you. So the standard deduction is just a flat number. Everybody gets it, and you use it to deduct your taxable income, your gross income, turn it into your taxable income. I'm not going to do a dissertation on taxes, don't worry. But if you can itemize charitable donations, health expenses, all the different things that itemizing allows you to write off, and you can get to a higher number than that 13,000, then you itemize. You always take whichever one is better for you. In 2017, when that standard deduction doubled, something like 95% of people can't beat that number anymore. They just take the standard deduction, which means if you are just cutting a check to the charity of your choice, you're not actually getting a tax benefit for it if you're taking the standard deduction anyway, right? You were going to get the same tax write-off no matter what, whether you donated or not. So obviously, it's still good to donate to charity. I'm not saying you're only donating for the tax benefit, but if you are going to donate, it's nice to get a tax benefit. So doing a charitable donation out of your IRA will allow you to not have to pay taxes on that amount, and it will count towards your RMD. So it'll save you taxes. And you can still take the standard deduction and get all that tax benefit. So it's a little bit like doing a both and rather than an either or, right? So it allows you to still get a tax benefit even though you're not actually itemizing when you file your taxes. I know that's a little bit of a nuancy point that I just made, but in short, you can get a tax benefit where before you probably weren't going to get one for donating. And you can donate the same amount. I tell people all the time, if you give $50 a year to, the Polar Plunge or whatever, great. Let's do it out of your IRA. It's $50. And yeah, is $50, is paying taxes on that $50 going to break your bank? No. No, what? You'd pay $10 out of 50, maybe. Depends on where your bracket is. But why not save the money? It's one more step to do it that way other than cutting the check. Why not just save the tax money? And it's really simple. We walk you through it. Once you've done it once, you'll do it again. And this is maybe an extreme example, and not everybody is going to be able to do this, but we genuinely have people who donate most, if not all, of their RMD to charity every year. And, kudos to them. And they're very, very generous people and great people. We actually just put out, by the way, I don't know if it's out yet or not, Aaron, maybe you can correct me, a list of all the charities that we were able to help people donate to, right? It wasn't us, it was all of you. But all the people who have done these charitable donations, we compile a list of some of the places they helped, and we're publishing that because it's really great that we get to impact the world in a positive way, not just all of you individually, but the world itself. And, there are even people we work with who meet as a family every year and decide, hey, how are we going to donate this chunk of grandma and grandpa's RMD this year? And then, we get a big spreadsheet that's like, well, Red Cross and this medical organization or whatever. And then we get a couple. I always look through the spreadsheet, and then it's like the Sea Turtle Conservancy, the Free Little Book Buggy, and I'm like, those are the grandkids this year. And it's fun. It's fun for them. It's fun for us to be able to help you do this, and it saves you money, right? So it's kind of the trifecta. That's why I harp on it so much. And it's not something that you might know about just from a quick Google of RMDs. So, for the one thing you should know if you're doing this for the first time, the tax situation on it, right? I already told you it's not taxable. You're going to get a tax statement even if you donate your entire RMD, which again, most people don't do that, so please don't feel bad if you're not donating a large amount. That's nothing, there's nothing wrong with that. It's about what's right for you. But you're still going to get a tax statement, even if you donate the whole RMD. And it's going to say you took out this amount of money, whatever the correct amount was, and you didn't withhold any taxes. And the first time you get that statement, it's going to freak you out a little bit because you're like, "Ooh, did I screw up? This is supposed to be not taxable." And I get a call that says, "Anthony, this is right, right? Like it's not taxable, even though this statement makes it looks like it kind of is." And I'll say, "Yep, yep, we did everything right." The reason you still get a tax statement, even for the amount that you donate, is because that's what shows the IRS that you still took out the right amount. Okay. There is a special line on your tax return that says how much did you take out from your IRA and how much is taxable out of what you took out. And then on that taxable line, if you donated the whole thing, you just write zero. None of it was taxable. And then I get people who say, "Ooh, that freaks me out too. Does that mean I'm going to get audited? Like, are they going to trust me?" They don't have to trust you. Eventually, and a little bit down the road, they get a report, the IRS does as well, confirming where the money went to which charity. So there's not going to be an issue. It's kind of a weird system, I'll admit, as far as how the IRS does it. So that's why I kind of try to prep people in the beginning. But bottom line, this is a fantastic way to give to charity if you were already going to anyway, get the tax benefit. By the way, you're also gifting pre-tax money, so you can potentially even give more than you were before, because most of the time before you were giving after-tax money, right? So now you can maybe even give more than you were before for the same effect, and it allows you to well, I already talked about the tax benefit, and it counts towards your RMD. That's the third point. So a fantastic way to go about it. Before I'm going to leave this up, but I do want to touch briefly on inherited IRAs. Okay. Um, I'll move so you can see the rest of the contact info. Inherited IRAs are IRAs, obviously, that someone has died and passed on to you. It could be a parent, it could be a grandparent, it could be a friend. The one place you can't get an inherited IRA from is a spouse, right? If they pass on an IRA to you, it just becomes your IRA as if you owned it the whole time. So then you don't have to worry about that inherited tag. You'll also hear these called beneficiary IRAs. Same thing, inherited/beneficiary. They mean the same thing. The key difference between inherited IRAs and their RMD rules and regular IRAs and their RMD rules is whether the person who died was already collecting RMDs themselves. Okay. And this changed back in 2020, and there's been some confusion around it, which is why I wanted to bring it up. If the person who passed on the IRA to you died in 2020 or later, so since 2020, and they were receiving RMDs, meaning they were 73 or older, you continue to have to take out an annual amount, and that entire account has to be empty within 10 years. Okay, let me say that again. Let's say I inherited $1,000 from my grandmother and she passed away in 2021. And it was an IRA and she was already taking RMDs. I have to take out a chunk every year, and we'll help you calculate that. It's a little bit different calculation. And by 10 years, so by 2031, I've got to have that account completely empty. That's the IRS rule. If the person who passed it on to you was not yet receiving their RMDs, then I don't have to take anything out every year, but I still have to have it empty within 10 years. So it's the new 10-year rule for inherited IRAs. Okay. So very shortly, we'll help you navigate all those rules. But if you inherit an IRA from anyone other than a spouse, because spouse rules are special, you need to have that account empty within 10 years of receiving it. By the 10th year is how the law is really written. I think there was a question. What if a person with an IRA passed away in 2018? Great question. If the person you inherited this from passed away prior to 2020, then you get to go under the old rules. And the old rules are a little bit simpler in that you don't have the 10-year requirement anymore. You still have to take out a required amount every year, but you can keep that beneficiary slash inherited IRA for the rest of your life. There's never a date where the money has to be out. That's what changed in 2020. Pre-2020, you had to still take out the right amount every year, but you could keep that account for the rest of your life. Just take out the minimum amount. It could continue to grow. You can use it whenever you want. Post 2020, now all the money in those accounts has to be empty, meaning taken out to you, not spent per se. You can reinvest it somewhere, but taken out of that original account within the first 10 years, by the end of the 10 years. So, great question. If they passed away prior to 2020, you do not have to worry about the 10-year rule, but you still have to worry about the year over year rule, taking it the right amount every year. So that kind of covers the basics. And again, you may have a question that, ooh, you hit on one topic, Anthony, but I'd love you to go into a little bit more detail. That's great. Please either ask it now, or if you want to ask it one-on-one, then we'll find a time either on the phone or on Zoom or in person or whatever. A quick clarification. Is that effective January 1st, 2020? Yes. Yes, it was effective so the rule changed January 1, 2020, not the end of 2020, but the beginning of 2020. It was kind of a bad year to make all those changes to these rules because obviously we were all a little preoccupied with some other things in 2020. But when they changed these rules, they did not know that there would be a global pandemic. So they changed RMD rules in 2020 and the inherited RMD rules. And that made it was an uphill battle for them to communicate that. But yes, it was effective January 1st. And I'm still open for questions, but what I want to do here is I actually want to run a couple questions by everybody. And specifically, we do events like this every month. And what I've just done is I've hopefully, if this worked, popped a poll up on your screen. We do these every month. And next month, we are going to be doing an event on what we call the state of the markets, which is really a market update. And I think it's going to be a really impactful one because obviously we will now have a new administration coming up here next week already is Inauguration Day. So if you would like us to just pre-register you for our next event, just hit yes on that first question and we'll get in touch with you and make sure you're registered and confirmed and all that stuff. And if you have any further questions about this and you'd like us to reach out to you and get in touch and set up a one-on-one, hit yes to the second question and we'll make sure you're on the list to do that. So while these results are being tallied, are there any other questions I can help anybody with related to RMDs? Or, you can ask whatever you want. I might say I'll follow up with you offline about it, but I'm always open for questions. And thank you, everybody. I see all the responses coming through. And again, if you say yes, that you would like to register, we'll just get you pre-registered, and then you don't have to worry about remembering to catch the email or whatever. And next month, again, we do our annual State of the Market, sort of like the State of the Union, and it'll be an interesting one this year. I won't pre-dive into it, but we've got a lot of things we're watching and are concerned about out there in the economy and the markets that we want to make sure you're all on top of. So I will double check. I don't see any other questions. Anybody have anything else they want to cover? RMDs, 73 is the magic age. You got to do it for the rest of your life, but we'll help you navigate it. Giving to charity is great. Oh, I see one question. If one spouse passes away, great question. So I alluded to this, but I didn't totally get into it. So thank you for asking. If one spouse, let's say you both have IRAs or even just the one who passes away, if it's a spouse, and assuming they have you as the beneficiary, right? You can put whoever you want as a beneficiary of an IRA. So just because they're your spouse doesn't necessarily mean they have to put you as the beneficiary, but obviously most of the time that's how it works. That's how my wife and I have it, where she's my beneficiary, I'm hers. Um, if you inherit an IRA from a spouse, none of the inherited IRA rules apply. Only the regular IRA rules apply. So if you're under 73, even if they were over 73, you don't have to take an RMD until you turn 73. That is a special rule for spouses where basically when you inherit an IRA from your spouse, you basically just put your name at the top and it's like it was your account all along. So all the rules then apply to you, not to that person. You don't have to worry about how old they were. The 2020 distinction that I mentioned, January 1st, 2020, you don't have to worry about any of that if it's a spouse, which is handy because obviously that's the primary way assets are passed is spouse to spouse and then eventually from the survivor onto the next generation. But it's really clean and simple to work with from spouse to spouse. Basically, if it happens with us where we're managing it, we'll get in touch with the surviving spouse. We'll say, hey, we're going to get this IRA transferred over to you. We can combine it with one you have currently, or we can keep it separate, whatever you'd like to do. And then from there, it's yours, and you get to do whatever you want with it, and the rules just apply to you as an individual. So, really good question, really important question. Thankfully, the spousal rules are easy. Um, when do you take RMD if you are still employed and are over 73? Great question. If it's your work account that you are still employed, and I'll caveat this that if it's a 401k or even some 403bs, worth checking with the plan. But for the county, for example, for Hennepin County, if you are still working, you do not have to take an RMD. And a lot of 401ks and 403bs are like this. You do not have to take an RMD from your work retirement account. Okay. If you have a separate IRA somewhere, you do have to still take the right amount, even if you're still working. So, literally, the job that you're working, most likely, and it's worth double checking, although I know this is how it works for Hennepin County. Every business can set it up a little bit different, so it's worth checking. But um, for Hennepin County, if you are older than 73 and still working, you do, excuse me, you do not have to take out your RMD for that year. As soon as you retire, then that year you have to start taking your RMD. And it is the year you retire, even if you worked, January 1 to December 30th and you retire on December 31st, that you still have to take the right amount for that year then. But for the work account, you don't. If you have any other IRAs, though, you do, or any old 401ks, you still do. Okay, so very important to know that distinction. Great question, but very important to get that right because it doesn't apply to everything. It's just the account for the place you're actively working for. So very good. Well, with that, thank you everybody for being here. We will see you next month on February 25th. You can see the date right above my head for our State of the Markets. And we'll get everybody who answered the poll pre-registered. So thank you, everybody. I hope you have a great rest of your day. Take care.